Hello and welcome to episode 335 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, I say this every week, I say welcome back, but I really mean it this week. Welcome back to the show. We missed you.
It's good to be back, Andy. It's the first time, obviously, that I wasn't on the show last week, so I listened to it and I thought you guys did a fabulous job. You didn't break anything, and it's good to be back. But it was a really good show last week. And if listeners don't know, I went away for a couple of days with my family, tried to switch off. But like whenever you go on holiday, it's never quite long enough, is it? Just at the point that you're starting to relax, then it's back to work, back home. But on top of that, I'm now going to tell people I've obviously an added stress going on. I've actually just exchanged on a house. So I've not talked about this at all on a podcast, which it's quite controlled of me, given that it's a money podcast, to not talk about buying a house and moving and all of those issues that go with that over the last 4 or 5 months. But the reason I mention it is because in the not too distant future, I'm going to do a podcast show or special, because oddly in our office almost everybody has bought or sold a house within the last sort of 12 months, and we're going to pull together tips and advice about how you can make the whole process from deciding to buy and everything as painless as possible. It can never be completely painless, as we all know, but things that I did to try and basically keep my sanity and be able to push the thing through with as few hiccups as possible. And I think that people would find that very useful. And so that actually inspires slightly a piece on the podcast this week, Andy. So I'll tell you straight away what's going to be on the podcast. So I'm going to do a piece about how to get the equivalent of a 30 grand a year salary as a pension. So that is the average wage in the UK, but I want to show people that it is obtainable. That sounds like a lot, and people always put off saving for retirement, but I want to illustrate how achievable that is for a lot of people if they just do a few smart things along the way. And the piece that's inspired by the house move is to do with paying money into account. So what happens if you pay money into the wrong account? Because obviously as part of a house buying process, you have to pay deposits across large sums of money. What happens if you pay money into the wrong account? What happens if you receive money that you weren't entitled to? So that does happen. I've known people it's happened too, where money just appears by accident into your account. What are the rules surrounding that? And finally, I want to do a piece on interest rates. So I don't do it very often, but I want to do something that's slightly contemporary, that will date, but when will interest rates go up? Because again, mortgages, very topical when it comes to house moving. People might be wondering, well, when will rates go up again? We hear a lot about inflation. Of course, rates rise typically to control inflation. So does that mean mortgage rates are about to shoot up? So I want to give people what the latest is on that situation.
Great. So I imagine we're going to go into the main piece straight away then, and that's talking about pensions and how you can build up a sizable pension pot with a relatively small amount being put away each month. So Damien, what have we got on this?
So it was quite a few years ago, actually. I wrote a piece, and I think there was a podcast show which I couldn't find, where I explained how to get a 25 grand a year pension for, I think it was about £30-40 a month, something like that. And it is a bit of an update to that, but a slight change to it, because the world of finance has actually moved on. There have been some more developments which people can take advantage of. And of course, the average wage has jumped up. I mean, we were looking at what the average wage in the UK is, and it's £13,000. It's just shy of £30,000, in fact, but we'll call it 30,000 for simplicity. And so looking at it, I went through the numbers and it needed a complete revamp. And so it's a perfect piece for the podcast because, as I say, the last time we did anything like this was quite some time ago, but I wanted people to see a bit of financial planning in action. So how can you get the equivalent of a 30 grand a year salary at age 65? So it's taken into account inflation and everything. So if you want £30,000 at 65, the equivalent lifestyle, what you've got to realise is you don't necessarily have to have £30,000. Say that you were earning that just before you retired. Because you won't have a mortgage, it's unlikely you will do, then there are other expenses that will reduce as you get near retirement. Typically, 2/3 of your final pay has always been something they used to do in final salary schemes. So what I'm going to do is say, right, to get to that £30,000 a year amount, roughly 2/3 of that salary is £20,000. That's what you've got to aim for, because that's going to give you that £30,000 a year lifestyle at retirement. So £20,000. Now, don't forget that we are entitled to a state pension in this country. And if you've got a full national insurance contribution history, you will get, as it stands, £179.60 per week, which works out to be £9,339 per year. Now, that is a sizable amount of money. So I'm talking about just individual people here. I'm not talking about couples, because obviously they would get a state pension potentially each, which obviously doubles that amount of money to over 18,000 together. So for a single person, you've already got £9,339 of that £20,000 amount that you would need at retirement. So I'm reverse engineering this. Now, that gives you £10,661 that you're going to have to generate in an income at retirement. Now, if you look at an annuity rate as a rough steer, it's almost exactly 5% at age 65. So if you have a pot of £100,000 and you took an annuity, not one that's going to take into account your health or anything like that, just bog standard non-smoker, if you had £100,000 at age 65, then you would generate almost exactly £5,000 a year income. I'm not talking about drawdown or anything like that. We're using this as an assumption. So the 5%. Taking that £10,661, basically you need about £213,000 as a pot to generate 5% a year as an income, whether you're going to do that via an annuity or if you're going to do it via drawdown. So that is the sum of money you've got to try and have in a pension pot by age 65. Now, one thing, obviously, the beauty of a state pension, it's going to be pretty much inflation protected. I know it's very topical and a lot of talk about the triple lock and everything now, but that's a positive about the state pension. Now, if you want to generate that £213,000 pot, okay, if you're age 30, that means you're going to start, you've got no pension at all. You're going to start today, age 30. You need to put in £400 a month to get that pot. And that's assuming a 5% growth rate, and it's assuming fund charges of 1.5%, and it's assuming an inflation rate of about 2%. So we're taking into account inflation when we're making these numbers. If you're 40, you're going to have to do £600 a month. If you're 50, you're going to have to do £1,100 a month. So there's some sizable numbers there for people who hadn't even started saving for a pension. Now, this is where you can start to get a bit cute. If you reduce the charges on your investment portfolio. So let's say you're going to do a pension. Instead of paying 1.5%, you used something that was much cheaper and got it down to about 0.5%, which is doable because there are a lot of cheap platforms out there. There are tracker products. If you got it down to 0.5% per annum that you were paying on your pension in total, then we already, for the 30-year-old, we're going to focus on the 30-year-old just to keep this simple, then that 30-year-old would only have to pay in £320 a month. So we've gone from 400 already down to 320. If, rather than just achieve 5% growth rate, they actually achieved something like 8% on top of inflation. So they took more investment risk. Now, I know it's not guaranteed. There is no certainty you're going to actually achieve that. We're talking about the average over the long term. So you took more risk. You're 30. You can afford to take more risk. You've got a 35-year time frame here. If you manage to achieve that, so you, instead of picking a low risk investment or a default fund in a pension, for example, you would only need to put in £110 a month as a 30-year-old. Then you would have the £213,000 you'd need at retirement. The other thing to bear in mind then, if we're focused on this 30-year-old, £110, now their basic rate taxpayer, let's say they're earning 30 grand a year, then that actually nets out, because you get tax relief on your pension contributions, you only have to put in £88 a month to be able to achieve that. If you follow those steps that I've said, if you were a 40% taxpayer, then that drops down to actually only £66 a month net. So you can already see we've gone from a 30-year-old, by just being a bit cute about things, we've already got it from £400 a month down to around about £88 a month, just assuming they're a basic rate taxpayer. Now, the final thing I want people to think about is auto-enrollment. Now, this is the importance of auto-enrollment, and it was a great initiative and it's been very successful. Auto-enrollment, what happens, as an employee, you have to pay in 5% of your earnings and your employer has to put in 3%. Now, the amount that 3% is based upon can be all of your earnings or something called qualifying earnings, which is between £6,240 and £50,270. Now, the reason I mention this is because If you earned £30,000 a year, then interestingly, that would work out to be £80 a month would be your net contribution into your company scheme if it was based on this qualifying earnings. Then that £80, you would have nearly £20 tax relief, and your employer would put in £59.40. Wrap all of that up, and you've got £158.40 a month going into a pension, a workplace pension via auto enrolment. You only put it in £80, yet you're receiving the benefit of £158. That is way more than the £110 that I mentioned earlier that people would need to put in. Not only that, but if, like some employers do, they decide to match your contribution, so they pay 5 as well as you paying 5%, then you'd end up with £198 in total going into your pension, which would actually give you the equivalent of 25 grand a year as a retirement income when you add in your state pension, which when I work it backwards, that's 2/3 of 37,500. So you can see very quickly what I'm illustrating here is if people are cute and they join their auto enrollment scheme at work, if they check that their employer, whether their employer matches contributions, or they make sure that it's a cheap scheme, or they save into a pension at very low cost, they minimise costs, and they don't just sit in a default fund. They actually go and choose and actively choose the investments that they're in so they can try and manage the risk and the potential reward. You can achieve a £30,000 equivalent income lifestyle in retirement for as little as £80 for a 30-year-old. Now, of course, if you're older, you're 40, then the numbers are bigger. But when we said at the start that the 40-year-old have to pay £600 a month, if you use the tips that I mentioned, you could get that down to £250 a month, which, given you hadn't even started saving, is a pretty decent figure. And if you think auto enrolment that was matched and you're earning £30,000 a month would actually get you about £200 a month going into your pension, and you only paying £80 effectively yourself, then you are quite a way towards that £250 a month. So the message here is don't think it's too late to start saving for retirement, and don't forget you do currently get a state pension, so you have to bring it into the round. It's part of your building block as we still have it. We can't ignore it, but it's just a good demonstration of if you pull the right levers, then you can achieve probably more than you thought you could when it comes to saving for retirement. And before we move on, actually, Andy, I'll just mention that we will produce this as an article that we can link to in the show notes at some point during next week. So if you are listening to this podcast, you can go on the site and look for podcast 335. There's always going to be an abridged version of our shows, but we will link through to an article that explains some of those numbers in detail and the numbers for other ages as well. So if you didn't get all those numbers, don't worry about it.
Okay, so moving on to the next piece then, and we're going to be talking about payments. What happens when you receive a payment from someone into your bank? How do you get it back to them? Do you have to get it back to them? Are you obliged to? And similarly, if you make payments elsewhere and make a mistake, what can you do about it?
Yeah, so just to start, we did a podcast 255, which was about authorized push payment fraud. So that's where you end up paying a fraudster accidentally. So we covered that and what happens and the rules and regulations around that and about getting your money back. This I want to talk about today is a bit different. This is relating to what happens if you put money in the wrong account. So it's different. It's not fraud. It's what happens if you pay money to the wrong place. Now, the reason this became topical because, as I said, I exchanged on a house this week, and as part of that, you have to pay a deposit to basically tie you in between exchange and completion. Of course, when you're moving money, you do get sweaty palms and a bit worried that you're going to end up sending the money somewhere it shouldn't go. So what are the rules surrounding that? Now, interestingly, there is now a code of best practice with banks on misdirected payments, and it outlines how banks should act in the unfortunate event that you send money to the wrong account. Now, one of the things I have to stress is that there has been a confirmation of payee service that's appeared on banks, which I think is fantastic, whereby when you send money to somebody else, then if I was going to send Andy some money, for example, and he gave me his bank details and I put them in and went to send money, it checks that the account name matches Andy Leaks. So it will alert me if there's something that appears wrong, so I don't then send money. It encourages me to go and check the details. So that is fantastic. And actually, 90% of bank transfers are covered by that service now. So the chances of mistakes happening are starting to reduce. But if you do accidentally send money to the wrong bank account, and I've known it's happened to a number of people I know who've done it accidentally, then you need to let your bank or building society know straight away, and they should take action within 2 working days under the misdirected payments code. Now, in most instances, the bank should be able to recover the money for you, and that will be the end of the issue. Now, of course, if the bank details were incorrect, they didn't actually exist, then the money would just bounce back. So you wouldn't have a problem. But if there were a valid person, then the money could enter their account. And as I mentioned, you should be able to get the money back if you contact the bank quickly. But what happens if you can't get the money back? Now, if your bank can't claim the funds straight away, it could be because the person spent it or they're disputing it. The bank will investigate and you should be told the outcome within 15 business days. If the funds can't be recovered, then the bank should give you clear and accurate information about what options are available to you. And they can include, obviously, taking out court action against the recipient, so the person who has the money. Now, of course, the tips to avoid it happening is you should always double check the details before you send it money over. And also send a smaller amount, send £1 across, and then see if the money gets cleared and the person you intended to get the money confirms they've received it, and then you can send a larger amount. But there are times where, despite the confirmation of payee service and the best practice of misdirected payments, where things can fall between the cracks. Now, there was an interesting article in The Guardian, which I will probably put a link to in the show notes, where this did happen and somebody was remortgaging and she had some money paid into her account. It was supposed to be paid into her account. I think it was something like £40,000. What she actually did was, when she completed the form, she accidentally put her son's bank details in the form. And even though the name didn't match, it was on the form, the payment went through to her son, and I think their relationship must have been a bit strained because he then kept the money, spent it, and there was a whole series, like a chain of events that went on, and she ultimately ended up taking him to court about it. So that's an example of what can happen if somebody doesn't return the money. The issue is that the confirmation of payee service doesn't cover circumstances where the customer isn't present. And by that I mean, when you're on your banking app and you therefore transfer the money, okay, it pops up and asks you a question. But if you fill out paperwork, forms, for example, then those checks don't occur and it doesn't fall under the remit of that confirmation of payee service. And I know what normally happens when money gets sent across to banks. As part of anti-money laundering, recipient banks usually query large transactions if they're sent across, and sometimes will freeze sums of money. But that only applies to faster payments. So like I said earlier on, if I send Andy money, there is an issue where the money comes from another institution, so bank to bank, then those checks don't take place. So what happened in this instance for this poor lady, because the money was coming from a bank as part of a mortgage application and the bank details were confirmed via writing on a form, then none of the safety nets or checks were carried out and the money went into the son's account, and there was very little she could do about it. Currently her case is with the Ombudsman, according to the newspaper, but it just goes to show that if you're filling out forms with bank details in there, you need to be doubly sure that you put in the correct details, because no one is going to do any checks. And if the money goes across to the wrong account, then the banks might not even react and freeze the money when it goes into that other account, even if it is a sizable sum like £40,000. So one takeaway from this podcast: if you're filling out forms, double, treble check what you're putting down for bank details, because you could cause yourself a massive headache. Now, going on to what would happen if you receive money into your account. Now, there's a misconception that people can't take it back, so the banks can't take the money back off of you. Now, that's not true, because you can get in trouble for retaining wrongful credit under the Theft Act of 1968. But there are bizarre instances where a customer may be able to claim that they have altered their position, it's called, on the strength of the money that had been credited to them, and they won't necessarily get into trouble. And an example would be if they were expecting a similar sum of money to hit their account and they therefore didn't check. They just looked at the balance and assumed it was part of this payment and then went on to spend it. Because there was a case that, if you go back to the 1950s, I'm not going to read out the name of the case, but there was a case where it was upheld that the person spent the money and hadn't done anything wrong. So there are obscure rules, but ultimately you are on the hook for the money. So don't think you could just go and spend it, and certainly never move it to another account. So if you get a lump sum appear in your account, don't move it into a savings account because it could be construed as theft. Now, one thing I want to move on to is a slightly bizarre one, is what happens if your employer pays you too much. So this is completely different to if you just get a amount of money that appears randomly in your account from somewhere else. What happens if your employer pays you too much? They might give you an overpayment of wages or salary or expenses, for example. Then the employer can legally recover the overpayment from the employee by deducting the overpaid amount from future wages. Now, in reality, employers can only make deductions from people's wages in very limited circumstances, but this is one of those times where they are allowed to do it. And it's interesting, but what happens if the person has left? So what happens if the person got overpaid money and then left the company? So they've gone. Now, the answer to whether they have to pay the money back will depend on what was written in the original contract, the employment contract of that person with the employer. And so there are instances where they may not have to pay it back. We'll put a link in the show notes for a bit more detail on that if people are interested. But what happens if you're overpaid as a freelancer? Now, again, that is something they can't take the money back off you, but you can allocate it as an overpayment, as a credit on your next invoice for that person or company, or do a credit note. So it's very interesting. Don't think if you get money in your account that magically appears that it's you've won the lottery and it's free money. You are going to have to give it back. But there are certain circumstances where it can be difficult for the people to actually get the money back off of you. So, for example, if you left employment or you are a freelancer. So there you go, Andy, a roundup of what happens if you accidentally send money to the wrong account or receive some into your own account.
And so moving on to the final piece of the podcast then is a hot topic. It always is, isn't it? Interest rates. Damien, you've got a short piece on this.
Yeah, so given that I'm thinking about mortgages and things like that, and people always want to know whether to fix or get a tracker. And so a lot of that is based upon what obviously interest rates are going to do, whether the Bank of England is going to increase interest rates. Obviously, hot topic is inflation at the moment, and people are talking about inflation going up. And if people remember from past podcasts, when inflation goes up, interest rates tend to be increased to quell that inflation. And similarly, if inflation is falling, then in an environment to try and stimulate the economy, they will cut interest rates. So interest rates are at a historic low, 0.1%. That's the base rate at the moment. Obviously, I don't know when interest rates will go up, but the market, so the money markets, are obviously having to make assumptions of what future interest rates are going to be. So you can use that information, and I'll put a link in the show notes to a page on the Bank of England website, actually, which looks at yield curves. Now, you don't have to understand what any of that thing is, but effectively, there's something called swap rates that occur. And there's a chart that is on this page, and it's at the bottom as I make this podcast. And it effectively can be used to predict where the market thinks interest rates will be in 1, 2, 3, 4, and 5 years' time. And you can see how those expectations and predictions are changing as well. So if I look now, where we are currently is that the market is predicting that interest rates will rise probably by the first quarter of 2022. So not too far in the too distant future. But they're not pricing they're going to jump that high. They're pricing they'll probably go up to about 0.25%. If you look at it and use it as a gauge, then in the next year, they probably think interest rates will be about 0.25%. But they don't think that interest rates will even get above 0.7% in the next 5 years. So that gives you a gauge. Of course, this is a moving animal, isn't it? It's one of those things that we could suddenly have some economic data that shifts all of the expectations in the market, and we could look at this in a couple of months' time, and they could be predicting interest rates are going to move higher much more quickly. But just to give people a steer, as it stands now, the market is expecting interest rates to start to rise in the next year, but they're not expecting them to rise that quickly. So you can take that information and use it as you wish, but you have to understand that it is not a certainty or any guarantee at all.
On that though, Damien, we hear this a lot though, and inflation's going to soar, so interest rates have got to go up, but they never seem to go up. So what's different?
I mean, it's a good question, Andy. It's like, what is different? Because after the financial crisis, everyone kept talking about eventually like hyperinflation, or we're going to have these crazy spikes in inflation because, quite simply, if you use quantitative easing and you keep interest rates low, effectively, let's call it money printing, because that's what QE, quantitative easing, is in effect doing. It's kind of like money printing. And just to keep it simple, if you imagine there's a money printing machine printing lots of money. There's much more money washing around the system and the economy, but the number of goods and services and assets isn't really changing at the same rate. So there's more money chasing a limited supply of goods. Then that means the prices start to go up. That's just kind of logical, isn't it? You're going to charge more. You end up going to have wheelbarrows of money going down the road just to buy a loaf of bread. That's what people were thinking would happen. But of course, it hasn't. And we haven't had that real pickup in inflation. And of course, we've had more QE now since the pandemic. And if you take the last 12 years or so as a guide, the likelihood of inflation suddenly spiking and becoming ingrained, you probably would argue doesn't seem that likely. So it's a good question. We do keep hearing it. And I don't know there's any certainty that we are going to see a particular spike in inflation. And going back to the markets and what they're pricing in, they certainly aren't thinking that we're going to have a spike in inflation that proves sticky. So we might have a temporary spike, but they're not pricing in that we are going to have a situation where it proves sticky. They are, if anything, thinking that the economy will still need to have interest rates very low, and it will be difficult for the Bank of England to lift them because of the impact on economic growth, because it would technically start to slow it down. It would mean consumers would end up having to tighten their purse strings, etc. So good question, but the markets aren't expecting inflation to soar. But then again, they could be wrong.
And so that's it. We're done. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. Twitter, it's @moneytothemasses with the number 2. And of course, we're in all the other places. Instagram, TikTok, we've got the Facebook group as well, and of course YouTube. That's it, we're done for this week. Until next time.